Hello everyone and welcome to South Dakota Sales Tax 101. My name is David Casper. I'm from the Eide Bailey Fargo office and I will be your presenter today. Before we get too far along, I just thought that you might enjoy this particular banner that I came across in Sweetwater County, Wyoming. The interesting part is that they want you to vote yes for the tax that you pay, or excuse me, that you don't pay that benefits us all. It's a lodging tax aimed at tourists. The interesting part of this was it appeared to be in the parking lot of their tourism and visitor center. Just seemed like an unusual place to put some advertising of that nature. One question we get quite a bit is, what is SALT? As we are commonly referred to in the accounting world, what our specialty is referred to as SALT. Well, this on your screen is SALT at a Morton salt factory in Utah. It's quite a bit of salt, but that is not the kind of salt that we are going to be looking at today. SALT is state and local tax. So if you hear an accountant throwing out the word SALT, this is what they're trying to say: state and local tax. Going to get through just a few of the basics here, just to make sure that no one is left behind. We're going to talk about sales tax first. And sales tax, we're all pretty used to it. Sales tax is charged at the time of purchase. So if I happen to stop into the Cox Standard here, grab a beverage and some snacks, I'm expected to pay sales tax at the time of purchase. Use tax is a term that comes up that a lot of people don't quite understand. And what is use tax? Use tax is paid for the pleasure of using an untaxed item. Use tax is paid by the purchaser to the state and is paid on untaxed items that are not exempt. For example, online purchases, eBays, Amazons. You're going to use it in your business. Had you gone uptown and purchased it locally, you would have expected to pay tax on it. The person who sold it to you for a variety of reasons did not charge you sales tax, so you, for the pleasure of using the item, are expected to remit the use tax directly to the state. This is a real grocery store. They actually do have this van and this gigantic cow. It passed me one day on the interstate doing about 80. I thought, now that is some marketing. And you have to think about this for a moment. So these folks at Miller's, they decided one day that they just had to have a giant cow. They sourced one. It was in New York. They got approval. They ordered this rather unusual piece of marketing. And our New York retailer did not charge them tax. This would be a typical use tax scenario. This is a North Dakota paper sales tax return. They're going to be very similar in most states. The important part here is, where should Miller's report the use tax on their giant cow? And as you can see here on line 3, North Dakota has an items subject to use tax line. It'll be the same in most states. And over on the right, they enter the dollar amount that they paid for the giant cow. This then works its way through the process, and the tax is paid to the state on the purchase. One key thing here is almost every business should have some use tax payable on their sales tax return. A complete lack of use tax is typically a red flag for the auditors. Even if you think back to the days when grocery stores would have actual pens on chains at the counter for writing out checks, the grocery store more than likely went to the office supplies section of the store, picked a package of pens off the shelf there, took them up and to the tills and used them to replace the captive pens on chains. Well, those were items from their untaxed inventory that were removed for internal use, and they would have owed use tax to the state on those items. Especially in today's world with items being purchased online quite a bit, almost every business will have some use tax amount. Perhaps in a month it's only $1, and in other months it may be thousands of dollars. But there should be something there. So we've kind of figured out what the sales tax is. We've got a handle on use tax. Now we need to determine, is it really a South Dakota sale? So in our top box here, if any of the following apply, this is a South Dakota sale. Item was delivered to South Dakota, regardless of who delivered it, whether it's UPS or somebody else. The service was performed in South Dakota, because South Dakota does tax services. The service was received in South Dakota. This could be receiving an auditor's report. This could be receiving an item that was sent out of state to be repaired and was shipped back into South Dakota. You've received that repair service there. Also, a benefit of the service, which is accessing cloud computing, such as your Netflix, Amazon Video, Office 365, any of those computer programs where you're having to log into them on the internet. So some examples are, package shows up at your door in South Dakota. Maybe there's an Apple Store invoice with your South Dakota address on it, or an audit report coming to you. What is taxable in South Dakota? Pretty much everything. Sale, lease, rental of tangible property, products transferred electronically, the sale of basically most services, and including according to the state here, dirigible and blimp rides. If there's anybody who knows where I can get a dirigible ride in South Dakota, please let me know. I will happily pay the tax to go for a blimp ride. I think that would be spectacular. Contractors provide services typically. Contractors are treated a little bit differently than a straight retailer. Some of the services they provide may be considered subject to sales tax. Some may be considered contractor activities, and we'll get to that in a bit. But the following services that we would think of as contractor type services are subject to sales tax. Connection of a satellite system for a homeowner is subject to sales tax, but systems for commercial use are not. Gross receipts from most floor coverings, landscape, lawn mowing, spraying, fertilizing, roto-rooters, snow removal, draperies and window coverings, locksmiths, also cleaning, calibration, adjustments to real property. This does not include the repair or replacing of parts. So imagine, if you will, someone adjusting an automatic door or a garage door, something of that nature. So when a contractor bills out these items, they need to be charging sales tax. So most things are taxable in South Dakota unless the purchaser gives the seller a completed exemption certificate. This exemption certificate is used to claim an exemption for items that are intended to be resold, such as when, in the earlier example, our grocery store bought the pens, put them on the shelf. They did not pay tax on them because they were intended to be resold. Products or services used for an exempt purpose, there's a few of those out there. And the exemption certificate is used to document that the purchaser is telling you they are exempt, they're signing off on this form. And if you're accepting these forms in good faith, that typically relieves you as the seller of any liability under audit. We do have a few exempt services in South Dakota. They're really pretty rare. Educational services, some farm-related services, some commissions. I've got trucking charges listed here as being exempt, but that is only trucking that is trucking. Or when you hired someone to pick something up at location A and deliver to location B, that will be exempt. However, if it's you sold an item that is taxable and you're putting a delivery charge on there, that delivery charge will be taxable. This exempt that's described here for trucking is for the act of delivering only, and that is not related to a sale of tangible property. Now there are a lot of construction services that are exempt. These are listed in the Contractor's Excise Guide, as we're looking down here at the bottom row. And that's a very complex topic that we really don't have time to get into today, but I can show you where they're at. Well, if you take your internet browser out to www.dor.sd.gov, on the left side, hover over the little tab for taxes, and then click on business taxes that's highlighted there when it pops up. On the next page, you will see on the left side, there's publications. You can open that up. There's one for contractor's excise tax and for sales tax. First, we'll look at the sales tax publications out there. And I have to give South Dakota credit. These are pretty decent plain language guidelines with real-world examples. The real-world examples and how they're treated seem to match statute quite nicely. The dates on them are all current. You'll notice there's 16, 17, 18 for the years. And that's good. There are states out there that have 10 and 12-year-old guidelines. Here, these are all current. The list is much longer than what's shown on the screen. There's probably 40 of these out there. So if you go off to dor.sd.gov, open up publications, click on sales tax when it drops down there on the left, and go ahead and read these. These will answer most of your questions. Oh, in that same publications bar, we could also click on the contractor's excise tax. And then I've highlighted where it pops up there, that contractor's excise tax that you'll note is also current. This goes into great detail about the contractor's excise tax, has good examples, and it will help you deal with contractor's excise tax. That topic is so specialized we just can't address it in the hour that we're allotted here. Also that will show up in there are some of these tax facts. They're kind of like little secondary publications the states put out. Good content. Let's highly suggest saving these links in your browser as a favorite. We also have these tax facts are alphabetical listed. You can see I've got one here for farm machinery attachments and irrigation units. We have them for attorneys, auctioneers, accountants. The state of South Dakota has done a really good job on these. More importantly, the question that we get is, how do I know what sales tax rate is? I know that the state is 4.5%. I know that I believe most, if not all, the cities are at a 2% rate. But how do I know if the location I'm shipping to is within or not in the city limits of Eden, South Dakota? How do we know that? Well, if we find our way to this tax rate finder on the DOR website, it's highlighted. It takes you to another page where you can enter the address, zip code, and the state will kicked back to you. These are the taxes to charge at that address. And that is a good tax rate that you can use. It's not, yes, there are services out there on the internet that do it for free, and this one is also free, but if you're using the South Dakota specific one, and say perhaps if it's a big dollar sale, you happen to print that screen of what the tax rate came back as, the state of South Dakota will obviously honor their own system versus some free one that you happen to find online. Strongly recommend using the state rate finders. Next thing that happens to a lot of folks is you get some mail from a Department of Revenue. Some of them may be a nexus questionnaire, which is asking you about your activities in their state. And nexus means having enough of a connection to a state where they can make you collect their taxes. That's the most common one, or sometimes you get some other letters from the tax commissioner. First step, contact whoever you work with on tax issues immediately. Please do not attempt to complete it yourself. What happens is, even though these letters are written in the English language, they are written from the tax department's point of view and translated into tax department speak, which is not necessarily the same as how you interpret it when you read it. So please have someone else read it and help you fill it out. Do not recycle, shred, or otherwise ignore these letters. You will continue to receive more of them, and then at some point you may just receive an assessment because you did not respond. Please don't ignore them. Don't throw them out. If you do fill it out yourself, have a tax professional review it. It can save a lot of straightening things out on the backside. If you receive an audit notice, the auditor says, we will be coming to audit you. Typically, they will want to go through your fixed assets and equipment accounts in detail. This is where your big purchases are. This is where they're going to go through every line item to see if you've paid the use tax or not, or if sales tax was properly charged. They will typically then do a sampling of your sales and your consumable purchases. They may pick a whole year out of a 3-year period. They may pick a couple of months out of each of the 3 years they're going to audit. We'll go through those, figure out a failure rate out of the sample, and then extrapolate that against the total business done in that period or the spend in that period. So, a missing invoice that had $10 worth of tax on it by itself may not seem like a whole lot, but by the time it's extrapolated to represent what probably happened due to the sampling method, that $10 worth of tax on that one invoice can easily be $100. So they'll detail the big ticket items and they'll sample pretty much everything else. What happens here? Here's a kind of an example. We sampled May of 15, December 14, and August of 13. They may have said, all right, we had a $2,000 fail in May, $1,000 in December, $7,000 in August. They'll add them up and come up with a monthly average. This is the most basic way that it happens. There are more complex methods. Usually end up in the same result. Well, we averaged a failure of $3,300 a month. They'll multiply that by 36 months, and that magically becomes $120,000 in sales and use tax payable to the state, plus penalty and interest. I believe your interest rate in South Dakota is something like 8%, 18% annual, or 1.5% per month. Let's say we have a missing invoice. It was $100, it can't be located. The auditor because you can't prove to them that you paid tax, your records are incomplete, they will have to assess you on this. All right, I threw it $7 into May of 15. That was the tax that was owed. If that was the only thing that they found, that goes into the average, becomes a couple dollars a month, times 36 months is $83 plus penalty and interest for a $100 invoice that can't be located. When sampling is involved, missing invoices can add up to some real dollar amounts. And the sad part about missing invoices is there may have been tax on it, or it may have been an exempt purchase, or maybe it was something that happened out of state that they have no claim to. But you did not provide the auditor with any sort of proof. They have no choice. They have to put it on there. Please, missing invoices are way easier to find in the month that they're missing compared to 3 years later. This is a tax wellness plan, we like to think of it as. First of all, file on time. Taxpayers who are habitually late are guaranteed an audit. File your returns as accurately as possible. Remit use tax, if you owe it, of course, but I would bet every business will have some amount of use tax every month. It may only be $2, but you have it. Take a look at those nexus creating activities that you're doing. And again, nexus is an activity that creates a responsibility to collect tax in a state. Maybe you never leave South Dakota, but making deliveries into Minnesota in a company vehicle is considered a nexus creating activity. And you may end up being required to collect Minnesota's tax. Just a good way to look at that. And above all, if you get those questionnaires from the state or those letters, take them to a tax professional and get some help. I've had clients who misunderstood what they were filling out. They answered them from a plain English point of view. The states interpreted them from a tax department point of view. Audit notices were issued when they shouldn't have been, and then there was quite a bit of stress getting the state to understand that no, this is what they meant, this is what happened. Your questionnaire was just confusing for the average person. Now let's do kind of a fun example. Wild Turkey Manufacturing. They manufacture sculptures and lawn art. And today they received an audit notice from the state of South Dakota. And it says in this audit notice that all untaxed sales must be supported by an exemption certificate. Okay, that works for me. And the deal with exemption certificates is for a tax-exempt sale where the item was normally taxable but you didn't charge tax, you must have the certificate on file. Best practices are gather these as part of your customer setup. If you're building a new customer in the system, get them now. Make the customer give it to you on the front side. PDF attach them to the client file. If you're keeping paper copies or only PDF files, keep them in more than one location. Water leaks happen, buildings burn, computers lose data. It would be a shame to have them only stored in one place and then have to recreate them, especially if your customer list contained several hundred clients with exemption certificates and you know the auditor is going to show up shortly. Get them on the front side or as soon as possible, store them in a couple of places just to prevent loss. And yes, as the world's largest turkey statue says, that does sound like a lot of work. But it is substantially less work now than when the auditor is sitting there and wants them all within, say, 3 weeks. It's much easier to get them a little bit at a time. So our sales are presumed taxable until you provide an exemption certificate. Wild Turkey will be allowed to pay the tax on taxable items sold without tax and without a certificate. Staff will be calling customers trying to collect 3 years worth of certificates in addition to their regular duties. Most offices don't have a second string of employees just waiting there for something to do, like calling exemption certificates. This doesn't happen. Now you have to do it in addition to your regular job and in addition to dealing with the audit. Much better to do it on the front side. When making these calls myself to track down certificates, I have heard this business is no longer. This business left the state. Oh, this business is not exempt. The owner is deceased. I am the new owner of the business and don't have any of the previous owner's records, nor do I want to sign off on anything for them. Please get the exemption certificates up front. A certificate today is worth about an hour of staff time under audit. How many certificates should you have? I had that conversation with a controller at a rather large tractor dealership. And I said, hey, that's great. You have quite a few. Why, yes, I do. I have quite a few. How many do you have? They had 11. They should have had in the neighborhood of 300 or 400. They had 11. It was quite a project, but we did get all of their certificates lined up and where they needed to be. Just in time, actually, as about 6 months later, they did receive an audit notice. That one, we got lucky on. Just think about how many hours you will spend trying to get them after the fact. Credit card statements. Corporate credit cards are a great tool for any business. Corporate credit cards with an inadequate documentation are your opportunity to pay another 5 to 8% in sales tax, plus penalty and interest to the state. In North Dakota, the interest rate is 1% a month. I believe South Dakota is 1.5%. So here's what happens. Our auditors showed up at Wild Turkey, and they asked for all the company card statements. And this is what they provided. The statement. Wild Turkey looks at these statements and sees all the miscellaneous travel expenses in one convenient location. And typically they don't require receipts, especially when it's the boss's credit card. What the auditor sees is a list of purchases, a dollar amount, and a date. They do not see a delivery location, because it's typically not on the card. What the item was, usually it's just a store and a dollar amount, or if any tax was paid. And what happens, much like our missing invoice before, until you can provide the auditor with a receipt showing an exempt item purchased, a receipt showing sales tax paid, documents showing use tax remitted, you get to part with some money. Because a credit card statement without supporting invoice copies is a nice list of missing invoices. If you think to those credit card statements, how many receipts are you missing? And how many staff hours will you spend calling vendors who may be out of business, unable to provide a copy? Imagine a lot of purchases at a Walmart. You're not going to be able to get an invoice copy from Walmart 3 years later. You just won't have the information. Some auditors are pretty decent, and if it's a Walmart or any major chain retailer or an airline, they will presume that tax was paid. Not all of them. You could call the vendors and say, yeah, we're on a new business. They'll say they're on this new business system and they don't have access to it. Or they're just unwilling to help. Think back and think to that missing invoice that had $7 in tax on it that becomes $80 some, and now question how many missing supporting invoices you have for those credit card statements. And not all receipts are created equal. As you can see in the receipt on the left, I did a little shopping at the Dairy Queen in Williston, North Dakota. There was a mushroom and Swiss and a classic cheeseburger to go, and there's tax of $1.24 on there. If you look at the invoice on the right, that's from a Subway, and it only says $8.72. What's the difference between the two, and what will the auditor do? The auditor will accept the Dairy Queen invoice, because this has a tax total line on it. The auditor will not accept the Subway invoice because it's just merely a record of the transaction. That $8.72 could have been a drink glass. It could have been some novelty item. And they may not have charged tax. The auditor does not know. They do not have a choice. Our $8.72 will end up on the audit. A lot of restaurants, for some reason, when the system puts out a receipt, it'll give you a detailed receipt like the one on the left, and it will give you a summary receipt like the one on the right. It's best to have the detailed receipt in your files. Now, here's an example. Maybe the names have been changed a bit to protect the innocent, but our folks at Wild Turkey, they received an order for a garden display. Tom Turkey has a vision of what this display will be. He heads to Craigslist to source some raw materials, gets folks on it right away, and this thing is done and completed on time and on budget. And a pretty neat looking garden display. Everybody's happy, except our friend the auditor. Tom bought the raw materials. All the auditor finds is a $5,000 payment labeled miscellaneous and no receipts. It's just a $5,000 out. The auditor has no choice but to presume that something taxable was purchased until you can prove otherwise. And we have nothing. We don't even have a handwritten, I bought these materials, or I sold these materials to Wild Turkey, my name is, and here's what the items are, a dollar amount, and no tax. We have nothing. We just have $5,000 out. The auditor has no idea what it is. They must presume it's taxable until proven otherwise. Receipts are everything. One thing that we run into is pick lists, quotes, and invoices are three different animals. The auditors need to see invoices, paying vendors from, and then filing as documentation. Quotes, estimates, or pick lists is not recommended because a quote, estimate, or pick list rarely shows sales tax and most likely won't match the final invoice because it's just a pick list with some estimated dollars on it, or it's just a quote. Most likely they're not going to match anyway. One example of this would be if our friend Tim Turkey wants himself a new desk. He picks it out at the furniture store. Our folks at the furniture store provide him a quote that they want to be paid up front before they order it. Payables cuts a check based on the quote, sends it to the vendor. Payables files the quote in the system as backup. The new desk arrives. Tim Turkey is all happy, and there was some paperwork with it, but the desk's paid for. He shreds the paperwork. Well, 30 days later, the vendor sends a statement showing the amount of tax due because there was actually an invoice that Tim shredded that was higher than the quote because it included sales tax. A couple of things happen here. Payables assume that an error was made on their end and they pay the tax difference to zero out the account. Or maybe the vendor sees the short payment, says, well, we made enough money on this, we'll just write it off and move forward. Auditor goes to the file for this fixed asset desk, pulls the quote, that's all that is there, has a quote with no tax on it. They have to put it on the audit assessment. And hopefully this isn't a sample, but it's a fixed asset, it shouldn't be, typically. Now, the folks at Wild Turkey have to figure out what happened, either try to get an invoice copy and try and unravel the whole works to see what happened with this desk. Because all we had in the file was a quote and not an invoice. There's a lot of folks out there on QuickBooks. QuickBooks has a couple of, I'll call them flaws. You can run your books on cash for accrual. You can also set your sales tax reporting to cash for accrual. Ideally, they should probably be the same. But some folks run their financials on one and inadvertently run their sales tax reporting on the other. Some states only accept accrual. North Dakota is one of them. I believe South Dakota is the same. You can end up with books showing one thing, sales tax reports showing another. It's all largely just a timing issue, but it can be very confusing to figure out in the beginning. Another thing that happens is people don't always lock a completed period, say last fiscal year. And if a customer comes in and says this invoice is wrong, you need to do this, then what will happen when these periods aren't locked is that the person fixing things may go back and open that old ticket, make the changes, reprint the ticket, hand it to the customer, who is happy, of course, because they have what they wanted. But when the auditor shows up and they rerun that period's sales tax report, it's not going to match what was filed. The filing was sent into the state, and that's a fixed period in time. Had our period in QuickBooks been locked, it would have also matched when the report was rerun. Because it wasn't locked and a change was made, now we have two different numbers that we need to try and figure out. If you're on QuickBooks, please lock your periods when they're done. It can save a lot of headaches on the other end. What will happen is if you're reporting and paying sales tax on a cash basis in a state that requires accrual or vice versa, in QuickBooks they can run a true-up report and you just are required to pay in the taxes that you have not collected yet. Again, please lock those prior periods. Sometimes it's not so bad to figure it out if you can track it to one invoice. But what if you have a company that does a lot of invoices, and a lot of invoices had to be fixed in a period? Now it gets really difficult to figure out what happened. And until you can prove it, the auditor has no choice but to take the amount that gives the state the largest financial gain. We'll just kind of skip through this again. This is about locking those prior periods. Please do that. Now, the next section of today's presentation has to do with remote sellers. We'll go into that in detail there. But for this section here, we're going to touch on it a bit. In the 1992, the Supreme Court said that a seller must have a substantial physical presence in a state before that state can make a seller collect their sales tax. For example, a few stray catalogs floating around in a state isn't enough. But having inventory stored there, having an employee living there, having an employee performing certain activities in a state, that is enough to create that substantial physical presence. And that standard is still in play. This summer, the Supreme Court said that A state who requires sellers to collect their tax when they derive more than 100,000 in sales or 200 transactions from a state is not putting a burden on commerce. So now we have two standards by which a state can require you to collect their tax. The new one, which is based on you made a certain dollar amount or a certain quantity of sales into a state, even though you've never been there, or if you didn't have any of those thresholds, but you did something substantial in that state, such as storing inventory there, making deliveries, having an employee presence of certain activities. Now you have to collect that state's tax. So it's either through your physical activities or your financial activities. So both standards still apply. Our big question is, if we take a look at this scene, it is a barbecue restaurant in a little town in Texas that is open 4 hours only on Saturdays, and only if the weather is nice. And they're super popular. As you can see, they draw quite the crowd. So, now, is Snow's Barbecue of Lexington, Texas, a remote seller? Well, we know they're a seller, as you can see by the lineup. And here they are with the big pits out back, smoking chickens and sausages and 80 or 90 briskets all in one setting to sell in this 4 hours that they're open. So, is Miss Tootsie, the lady here at the Smoker, is she a pit master or a remote seller? Well, every business has a website these days. Let's go to her website and see. That's right. I can go to their website and order online, put it in my shopping cart, and they will ship it to me overnight. Well, they are a remote seller. They may have never left Lexington, Texas. But if they have shipped more than 200 invoices worth of sales or $100,000 worth of their very delicious product into a state such as South Dakota that has a threshold, and the product is taxable, which it will be, they need a South Dakota sales tax permit. So here we have someone who you would not believe to be a remote seller is a remote seller. So what happens next? Well, I would strongly suggest you go home or back to the office, take a look at your exemption certificates, what you think about your invoice retention process or accepting invoice process. If there's some changes to be made there. Contemplate if you are a remote seller. As we looked at the folks at Snow's, they are a remote seller, and when we looked at them from the outside, you wouldn't think they are. Maybe you are shipping products all over the country, and you need to be considering these new economic nexus thresholds. So are you a remote seller? Should you be collecting tax in other states? And the second half of this presentation, we will delve into detail on those topics. I'd like to thank everybody for taking the time to sit through this with me today. If you have any questions, my contact information is here. Feel free to send me an email or give me a call, and we'll see if we can help you out. Thank you very much. I am David Casper. I am the state and local tax person for North and South Dakota, Minnesota, Guide Bailey. And what we're going to talk about today is how the world has changed for a retailer as of this summer. It used to be that if I did not leave home, if I did not leave my home state, I did not have to worry about collecting sales tax in another state. For example, this morning I was at a salvage yard here in South Dakota and I picked up a couple of pieces from a nice gentleman. And he had a gigantic pile of UPS sitting behind him that was waiting to go out. 5 years ago even, because he never left South Dakota with his delivery truck, he could ship items all over the country and didn't have to worry about sales taxes. That changed this summer in June. Our Supreme Court, in their supreme wisdom, has determined that requiring a retailer to collect tax in a state where they've made more than 100,000 in sales or 200 transactions is not a burden on interstate commerce. Now we have two thresholds here. We have the old one. If I'm leaving home, I'm going to another state, I'm in South Dakota, I go to Minnesota, I'm doing things over in Minnesota, I probably need to collect Minnesota tax then. Or if I wasn't doing that, but I've got enough sales into Minnesota, they could make me collect their tax. It was not, the old version didn't disappear. They're both still in play. So who's a remote seller? Well, I'm going to date myself a little bit. I've ordered things out of catalogs where you put the thing in with your money order, you send it in. I've done the fax order and had stuff come to me by COD. Nowadays, we can use a shopping cart, or one really popular method that people wouldn't think is popular, phone. Phone is still a real deal for remote sellers. Just think of all the heavy equipment that gets sold over the phone. That is a remote seller. And I don't know if there's a fax machine out there that works anymore. Nowadays, we're doing it in chat boxes and shopping carts. But at the end of the day, anybody whose product or service ends up in another state is a remote seller. This is Snow's Barbecue. They're open Saturdays like 8 months out of the year. All they do is barbecue. They do it very well. This is Miss Tootsie doing barbecue. I believe she told me that morning they did something like 80 or 90 briskets just that morning, in addition to several hundred chickens, everything else. And she's a super sweet person. She doesn't look like a remote seller, does she? She looks like somebody who does pretty good eating. But there she is on her webpage, and I can order her barbecue over the phone, through the shopping cart. They'll overnight it out to me in Fargo, North Dakota, where I'm at. That very low-tech looking operation, based on some different skill set, Miss Tootsie is a remote seller. That, just like any one of you, might be a remote seller. So it's not all about eBay and Etsy and Amazon. I think she is. I really believe she's a remote seller. You can also buy coffee cups, sauces, shirts, anything you want from her. So now that I've said Miss Tootsie is a remote seller, do I have to tell this very nice lady that she needs to register in 45 states that have sales taxes? I don't want to. This concept that came through the Supreme Court this summer, the fancy word for it is economic nexus. That's what they mean. There's about 4 different ways that the states have written their rules so far. They couldn't all write the same rules. But we managed to kind of box them into 4 styles. The OR group, of which South Dakota is one, says if you make 100,000 in sales or 200 transactions, and a transaction is a sale or an invoice. It's not 200 of something or 200 line items on an invoice. It's per sale, per invoice, the transaction. Also important to remember in this 100,000 number, if you are someone who sells mainly to resellers, so they're exempt, those sales count towards the $100,000 limit. So it's not just retail sales, it's all sales. Some of the OR states, there's a couple different thresholds, but by and large, most of them are OR states. They come the AND states, or the gross dollar states. They're looking, most of them, for 100,000 in sales and 200 transactions.
which is kind of interesting because it gives, let's say I sell 2 big pieces of machinery that got shipped to an and state. I probably had $500,000 in sales, but I only had 2 transactions. I'm good. I don't have to register. There's a few states that say, we don't care how you do it. It's a dollar amount, whether it's 1 sale or 300, it doesn't matter. A couple of them are like 250,000. We've got a few choice states out there. They're a little more dangerous water. They say we have our threshold, and once you hit our threshold, you need to make a choice. You either collect our sales tax, or you can choose to follow all of these different regimes that we have out there where you are supposed to put notices on your website, put notices in with your invoices, send year-end notices to the state about who bought what. My position so far has been to properly do this reporting on people is so difficult, and if you get one thing wrong, it's considered a fail across the board, and they fine you. And some of these states are $10,000 and $20,000 fines for as simple as forgetting to put something on your website. I honestly believe you're better off registering and collecting tax 80% right, and if the auditor shows up, your risk is 20%. You've done your best to do it instead of missing one little thing, and it's a pass-fail test with that reporting. You passed or you failed. Like, you're better off registering, and if anybody asks me, I'll tell you just register. I think you'll do better. Then I've got a couple of unique states, but we'll hit those at the end. So the OR states. Of the 45 states that have a sales tax imposed, I think we're somewhere in the neighborhood of 38 or 39 of them have posed these remote seller rules. If you registered for this online, don't beat yourself up trying to write these down. They will email out the listing or the PDF slide deck for this, and it'll all be in there. And we have it posted on IkeBailey.com. But big message here is most states are OR states. You can see we've got Arkansas through Nevada is 100,000 or 200. It's also important to look at those beginning dates of when they were going to begin enforcing that. Like Hawaii's came out, said, we want you doing this right away, right after the ruling came out. Is that reasonable to have expected you to do that? Probably not, but that's the date they put out there. When they're throwing up these numbers, initially in 2018, they were saying, did you do $100,000 in our state in 2017? And they said, if you didn't do it in 17, have you done it thus far in 2018? They're just looking for you to cross that line one time. Now that we're in 19, my assumption is that they're saying, did you cross the 100,000 line in 18? So they've got, some of them have been in effect for a while. There's not much we can do about that. We've got more OR states. Most of them are OR states. New York had a law out there for ages that they really couldn't enforce. Had a $300,000 line to it. Texas, we're waiting on them. I've heard 500 is the line, but there's nothing official yet. I have a question in the back of the room. Ship to, not where you build it, but where the box ended up. That can be sold to versus shipped to can be kind of a big deal if you're dealing with, for example, a hotel chain where it all gets billed to the hotel chain office in Sioux Falls or Fargo, and you're shipping stuff all over the country. They're going to look at where the boxes landed. I believe District of Columbia just passed their rule the other day, and again, at 100, 200. I've got some gross sales states here. Alabama, 250. Ohio, 500. Ohio and Tennessee are both at 500. I'm expecting that to change simply because if you were a state tax department and you had a $500,000 threshold out there and all these other states were at 100, wouldn't you want to drop yours to 102 to increase those revenues? Oh, I would see it happening. Oklahoma came in at 10,000 for whatever reason. Connecticut is an and state. Let's think of them as that two big pieces of equipment. I sent in $500,000 with a bulldozer twice, but I didn't have 200 sales, so they're cutting me some slack. Mass is the same way. It's an and. I believe those will probably change out in the next year or so. Begin to think they're coming up short. Idaho is an odd one. Took me a while to figure out what it was. Their rule says you're getting 10,000 in sales in our state, not much, and you have an in-state person sending you the sales. And we thought about that for a while, and there's all those online refer things that you click through. And well, is it that? Then it dawned on us that who that really applies to is I've seen a store at the mall where you go in and you try on a bed and then they hand you a piece of paper and say, go online and order this. That's who we think that applies to. So probably all the lectures we've done on this, it hasn't applied to anybody yet. But I do know that one of my coworkers did this lecture in Idaho a while back. They had half a dozen people there from the Idaho Department of Revenue. They were looking at how to change their rules. I would expect to see Idaho change within the year to more like everyone else's. Minnesota's is kind of neat. It's $100,000, and you got there through at least 10 transactions. So think of that part as an and. 100,000 by at least 10 transactions, or 100 sales. Well, I could be shipping $10 boxes of sparklers into Minnesota. If I send 100 of them, I need to register. For the folks here in the room, it's not coming through very clearly, but this is a little steakhouse outside of Abilene, Texas. You turn off the road and you go across the cattle crossing, and the big sign there says, cattle buyers go right, steakhouse go left. Well, I believe this is actually one of their barns at one time. One of them. It's a really high-ranked steakhouse. Now I walked in and it looked like a lot of places I'd been into. Small town, wherever. I'm like, yeah, okay, I'm familiar here. We just gotten done doing a remote seller lecture where, by the way, the technology worked perfectly. It's just this room. You know, is this guy a remote seller? We looked around and we didn't think so. Got back to the office the next day, was talking to one of the partners. He said, well, you know, they do these mesquite smoked beef tenderloins for 125 bucks a piece. And around the holidays, they ship out thousands of them out of that one little steakhouse. And you go to their website, you buy them online. And they overnight them to you and wherever you want to be. So yeah, my steakhouse is a remote seller. So if you've always kind of thought I'm not a remote seller, think about my steakhouse. You noticing the food kind of connection here with all of them? But if you're thinking about it, maybe think about these folks who clearly you didn't think of them as a remote seller in first glance. Think about them and then kind of look at what you're doing. Now that we've given it away, are they a remote seller? Everybody's going to say yes, they're a remote seller. You can also buy his autographed cookbook. Everything else they can think of to market. And it is that good. Earlier we talked about that reporting or collecting thing, and I'm not a fan of it. I would hope that none of you are. I believe I've got a slide coming up here that covers some of that. So here's Washington. Washington is a report or collect. If you make more than 10,000 in retail sales to Washington, and Washington is one of the few states that specifies retail, but by and large, just think of it as all sales. You must collect our tax or follow the use tax notice. Okay, so choice one, collect and pay tax, my favorite choice. Talk to us about If you met it last year, in 2017, you need to be registered and collecting by January 1, 2018, long before the Wayfair ruling, because they were giving you the option of doing their reporting, which had already been through the Supreme Court, or collecting. But you should have been doing this last year, actually. Or if you meet it within this current year. They also talk about, they have a B&O tax, which is business and occupation. Think of it as an income tax. You fill it out on your sales tax return, and depending upon what you're doing, you just tell them what your gross sales were in the state, and they take a percentage of that. It varies from 0.5% to like 1.5%. Or, here we go, use tax reporting requirements. You must provide a platform notice, which means I log into your website, I'm looking at it, I pick some stuff out, I go to the shopping cart, there should be a deal that pops up, says, hey Dave, we don't charge Washington sales tax. You might owe Washington use tax. Then when I get my printed invoice, because we always keep the invoices, there should be a notice printed on that. It says, dear Dave, we didn't charge you Washington sales tax. You maybe owe it. And then at the end of the year, you're supposed to send like a year-end statement to the Washington customers saying, you bought these many things from us. You probably owe you Washington use tax. And you have to send in an annual report of everybody that you sold those or sent those notices to the Washington Department of Revenue. And I believe, let's see if I got it on the next slide here. Yeah, looks back, sorry. The minimum fine on Washington is $10,000 statutory. It's pass, it's fail. If you got one thing wrong, it's $10,000. That's why I like maybe you're better off just registering, getting that sales tax permit if you're doing enough business there, doing the best you can to collect the tax right, and deal with the little bits that you miss later. Because getting all of that done perfectly every time, it's kind of hard. It's purposely hard. They want you to fail. They make it so difficult. They wanted you to register for the tax. Colorado started theirs the summer of 17. They had a $100,000 minimum, and they stacked their fines up. $5 for every time you missed the language on the invoice. $10 for each annual summary you forgot to send out. And the annual summary to the state, I believe, was $10 for every name that you missed. So far I haven't heard of anybody being audited on this yet, but it's coming. I really think it's coming. Then recently, Colorado just kind of gave up on that. And they said, if you're doing more than 100,000 in our state, you have to register. But that reporting regime for that window that it was available, that's still enforceable. Like looking back in your history. That's one thing we're a little bit worried about. We look at this timeline, we think of all of 2018, going left to right there. That second line down, it's a really long line where we could have been doing either. We could have been collecting or we could have been reporting. Well, then they come 1st of December with mandatory registration. All right, so I've gone and registered. But that annual report I was supposed to be doing and the annual reports to people I was supposed to be doing for the first 11 months or so of the year, that's still due. I haven't heard if they're going to be out there searching for people who didn't send them in or not. But if you think about it, when they forced me to go and register, I told them who I was, where I was. I have to tell them what kind of sales I'm having in their state. I'm giving them all the information. I'm just waiting to see if somebody like Colorado says, hey, thanks for registering. You've got really good sales here, and we waited till past the deadline for the end of year report to come from you. It didn't show up. You've told us you had really good sales. we'll be coming to audit, or here's a bill. There's been no noise yet out of the state whether or not they're going to do that, but can you see it happening? I can. Georgia came out with theirs just recently, and they said, beginning 10 days ago, if you're over 250 or 200, you can choose to go through all that same stuff as Washington, or just register to collect their tax. If you're having to register in 3 or 4 states, what's one more? It's a lot easier than to keep a bunch of different reporting requirements separate and deal with it. Pennsylvania, same deal, $10,000 minimum. Go and drop down a few lines. Look at the minimum statutory fine, $20,000. You could have $15,000 in that state. You didn't do your reporting right. Technically, they can hit you up for 20 grand. Ouch! It doesn't even seem like punishment fitting crime, does it? It's kind of a rough deal. I haven't heard of anybody getting hit with it yet, but if you were the state of Pennsylvania and all you had to do was collect information and send out these fines, wouldn't surprise me if they do it. Rhode Island, $100,000 threshold, $10,000 minimum fine. Either you did our reporting 100% perfect, or you collected our tax. And everybody's reporting and notice requirements are just a little bit different. So it's way easier just to collect the tax if it applies. Vermont, hopefully, it's Vermont, same deal. And Washington changed it up a little bit. Let's see which one this is. Yep, they changed it up again. I believe I've got the wrong date up here. But Washington said, if you're under 10,000 or the 200, we really don't care. If you're in that range of 10,000 to 100,000, you have to choose. And I believe if you're over, then you need to register. Again, it's just easier to register and collect it. Let your computers do the work for you. Now it was 10-1, they did that. $20,000 fines. Just punishment does not fit the crime. And again, that year-end reporting, they told me I had to register. Well, I've gone and done my registering. I told them what my sales were. If my sales were high enough, I really need to send in at least a year-end report to try and comply somehow. And as most people have noticed, it wasn't like you got letters from all these states telling you. I know a few people who, really huge companies who got personal phone calls from North Carolina Department of Revenue. A couple really large companies that got letters saying this is how it works. But most of the companies, unless you're here today, nobody's told you. Or you've heard just a little bit, so there's no detail. They're kind of setting you up to fail. It's not nice. This is their business and occupation tax in Washington. They can subject you to this tax if you do over $285,000 in sales into their state. Picture yourself as an equipment dealer. Okay, what's combine and header these days? Will anybody in the room tell me over 300 grand for a nice one? Yeah, thought so. What if I am a small town John Deere dealer? Somebody calls me on the phone, wants that combine. I'm a salesman. I'm going to sell it. I'm going to put it on a truck and I'm going to send it to Washington. I've exceeded the threshold not only for their sales tax, if that combine's taxable when it gets there, also their B&O tax, which can be 0.5% to 1.5% of whatever my sales were. And it's not like Washington came and told you about it. But these things are out there. So I've never left my dealership in Eden, but I traded a used combine I had to a dealer in Washington State for a baler that he was going to send back to me in cash. I had somebody else haul it, so it's not like I left town. Is it possible I could be subject to Washington business and occupation tax? Absolutely, depending upon If the value of that combine was over 285, or the number of deals that we did was 3 or 4 deals in the year, maybe they added up to 285,000. Absolutely. I am a remote seller, and in Washington, I could be subject to their extra tax there. Income taxes. Income taxes are not something they let me do. It's just a good thing, but I do know enough, and I've encountered this a few times now, that registering for sales tax can also bring some other reporting issues. Some states have taxes based on gross receipts, some version of an income tax, like we looked at the Washington B&O tax. Some states will use an economic nexus to impose their tax. There's a couple out there that say any positive revenue coming from our state is enough to create an income tax filing. Now, this is where I say, talk to your tax preparer about this. Let them know what's going on. Let your tax people know that, hey, I'm getting sales tax permits in 5 or 10 or 15 or 20 states, and let them know what those states are, so they can take that into consideration along with what it is you're actually doing, because some activities in the state may be subject to sales tax, but they're not taxable for the income tax side. So please tell your tax preparer where you're registering and what's going on, so that they know. At the end of it, in these states where they say one creates the other, you've got the sales tax permit, they've got your name, they've got your ID number. They're going to be waiting around to see if the income tax return comes. But it makes everybody's life easier. Just let them know ahead of time. Again, I can't go into detail on that part of it, but the folks here or your tax preparers certainly can. I did slides up front on this, showed you all these different states, all these different numbers. We know that they're still changing. You still think, how am I going to deal with this? How am I going to keep track of this? You got that. iBailey.com. You're here, you're signed up online, so we know you know how to get there. Over in the upper right-hand corner, there's that little tiny magnifying glass. If you click on that, type in the word Wayfair and hit enter. And then if I can hit this correctly, it's going to pop up with that bright yellow sign on the left, and the state responds to Supreme Court of the United States Wayfair decision. Select that article. It's going to take you to an article. The actual, what was written in the article, it's okay. I think we did all right on it. It's pretty static. But in the middle of that article is this table. And this table, we are updating it as it goes along. It's pretty much a live table. This is an old screenshot where it says California to be determined at $500,000. If you go look at it right now, it will say California implementation date April 1, 2019, and $100,000 threshold or 200 transactions. It's live. If you can search on the website, go for Wayfair, it'll take you to this. This will get you started, if you're wondering. And it's live, and we don't have any intentions of taking it down anytime in the near future. True or false? Updated information about Wayfair on iBailey. Mandatory answer, true. And this is today. Everything can change tomorrow. Our politicians might work out something wonderful, or they may not. Some of these states that had higher thresholds may lower them. Some of the states with the reporting requirements might just take them away, make life simpler. Some states may raise their thresholds, but I'm not betting on that. One of the big things here is if you look at this today, you start working with this today while it's new, and you start registering, and a lot of you are wondering, how am I going to figure out all these local taxes? How do I know what the tax is in Eden, South Dakota? There's software out there for that you can hook to your business system. But this could all change. But if you start now and you get better at it going forward, you've covered a lot of your risk. You've had your opportunity to collect the sales tax from the buyer. If the auditor shows up 4 or 5 years from now and says, hey, why weren't you collecting California sales tax? We know what your sales were. You owe us this sales tax. You get to pay it. It comes right out of your bottom line, and that's what hurts. When you had the opportunity to get it from the buyer and take it from their bottom line, not yours. Now comes the warnings, just like anything else. Remember we talked about physical presence, boots on the ground, making deliveries in another state. That physical presence could have created in the past a need to collect sales taxes. Maybe it wasn't on your radar at the time. You weren't thinking about it. Maybe you had your trucks making deliveries in Oklahoma, or you had salesmen driving around the countryside knocking on doors in other states. Maybe you've already made that connection with the state, and now you're only looking at the economic side. When you go and register, what will typically happen is either as part of the registration process or as a letter afterwards, the states will come back and they'll say, hey, tell me about what you've done in our state. There'll be a long, like 13 pages of questions. Some of them are income tax related, but a lot of them are sales tax related. They'll ask you, have you made deliveries in our state in your own truck? Have you had salespeople in our state? Have you resolved warranty issues in our state? Have you been here doing things? And if you say yes, and you're already registered, likely what will happen is they will come back and they will, with a nice letter, and say, please file sales and income tax returns for the past 4 years because you said you created that connection with us by doing these things 4 years ago. That hurts. But if before we register, we stop and we go talk to our salespeople, and actually one idea we had come up the other day is if you're running a lot of delivery trucks, and you've got new enough trucks that they're on electronic logbooks for your deliveries, pulling those IFTA reports, or even just looking at the old IFTA reports for the fuel taxes to see where you were, what states you were traveling in with your delivery trucks, in case you don't remember. Going back, talking to your people, saying, where were we, what were we doing that could have created this nexus for us? Once you get that figured out, you have this opportunity before you register, because after you register for sales tax, it's off the table, to do what they call a voluntary disclosure agreement. People will throw it out as VDA. The simpler way of thinking of it as is as getting right. You have the opportunity, typically, to do it through a third party initially, like myself or whoever your tax person is. I go to the state, so let's say it's Oklahoma. I go to the state of Oklahoma and I say, hey, I've got a client out there. They realize that they maybe needed to be collecting your tax a couple years ago. What can you do for us? We'd like to get right now, and then we'll register. Most of the states will come back and they'll say, well, we'll waive all the penalties. That's helpful. Some states will even waive interest. Texas did that this winter. Or we'll waive a part of the interest. Some states won't waive any interest. They will need to submit to us a spreadsheet of all of their taxable sales and why they're paying us the money. Sounds like a lot of work, but here's the deal. It gives you a chance to look back, look through your sales, talk to your customers, see if they really were exempt, and you take that big list of sales and you start whittling it down until you get, oh, okay, I had resale certificates for a bunch of it. I've gotten resale certificates, or those buyers accrued use tax. Maybe I only have 20% of my sales I owe the tax on. You get to do it on your own terms. You get to do it like on your schedule. It's not like an auditor has showed up and is turning all your books upside down. And you send it through, you pay the bill, unfortunately, and then you can go forward. But if the state is usually if the state's made any contact with you before you make contact with them, all that's off the table. They'll want to audit. It'll be full penalty and interest. Really stop and think. Look at what you were doing before. See if there's anything hiding under the bed or hiding in the closet. and deal with it before you say hello to the state. And always talk to whomever you talk to about your income and your sales tax. Still, it's a lot to take in. People, no matter how hard we try, it's like most even trainings I go to, you're gonna retain just a little bit of it. Hopefully, I haven't scared you too badly, but there is a way that we can help. You say, Dave, how can you help me? I can. If you can get me your sales by ship to state, where you sent the boxes, the number of invoices, and where you're filing now, where you've got employees and such. I'll have a short list of questions. You get me that information. I run it through some charting that we put together in a little program, and I come back to you and I say, here's one page. States are down the left. Here's your sales numbers. This is what you said you were doing. You've crossed these thresholds. You need to register in these states. And oh, by the way, before you register in these states, maybe you should look at doing the VDA or getting right in these other states where you told me you had an employee limit, or you told me that your fuel tax logs showed you were traveling in Missouri or Texas. Any of that. One page, and it's pretty easy to digest. And then it comes along with a separate chart that's got all the registration links for as many states as we've been able to compile. It comes with some of the reporting information that if you wanted to go down that road, it's $500. It's not a big fee. We're just trying to get the message out and get you started down the right road before it becomes 5 or 6 years later and the auditor's standing there. It looks something like this, except it's filled in with numbers. And usually when I do them, if I feel you crossed whatever the line is, it's going to be a bright green or a bright yellow. A couple people in the room have looked at them. Sometimes when I deliver those, I am not popular. I am very much not popular. One gentleman, I told him to register in 44 states. That was not a good day. I did have one company was only 2 states. It was all right. But depending upon what you're doing, be ready to hear at least 5 states, I would say. And we've made it to the end. Do we have any questions in the room? Yes, ma'am.
How far back to the voluntary disclosures go?
Question is, how far back do the voluntary disclosures go? If I find out that I've been doing something I shouldn't have been doing and I want to get right, they vary by state. Usually it's 3 or 4 years they look back. I can't remember which state it is. I believe it's an East Coast state that goes back 8 years. Anybody else? Yes.
Do you allow the state to consider a trade show sales in the state versus actually being to a customer location?
Question comes up, what about trade shows? If I'm at a trade show and it's the kind, okay, if I'm attending a trade show to see what everybody else has got going on, not an issue. So I'm just there to see what everybody else is advertising. If I'm set up at a trade show and I've got my booth of stuff, these are my wares, please talk to me about it. You know, here's my cards, let's connect later and see if we can make a deal. Some states will give you 3 or 4 days a year. North Dakota is a state that says 1 day and you're done. Texas is a state that says 1 day and you're done. It varies by state. But a lot of times if you're just going into a state like once a year and it's for a couple of days for one of those showing your wares trade shows, you can kind of get away with that. It's when you show up at that trade show and it's like, we've all been to the county fair and you go through where people are selling all the fancy sunglasses and drill bits and all that, where you're making cash sales over the counter. That's done. That's Nexus right there. You were there making sales. There's a few states with some thresholds on that, but just think of it as if I'm making sales over the counter, done.
How about if you have a salesman traveling?
Traveling salespeople.
Traveling salesman just
Okay. Question has come up. What about a traveling salesperson visiting customers in another state? Now, there's laws written about this that go back to Wrigley's gum, little yellow silver sticks in the 50s. Now, just a traveling salesman, if we picture of a traveling salesman in the Wild West who had a sample case, and he would say, hello, how you doing, Mr. General Store? Please look at my selection of eyeglasses. And then write in and order them from New York City, where he's just showing the wares. That's all he's doing. That is protected as solicitation. Any activities beyond that are not protected, and they create nexus. So what happened to Wrigley's gum, everybody picturing that little yellow packet, the Wrigley's gum reps, I believe it was in the 50s, would show up at whatever the grocery store was. The grocery store would say, well, we've got some old gum here. It's defective. It's dried out, whatever it was. The salesman would go out to the trunk of his 1950s car and bring in some fresh stuff that he had and exchange it out right there. He was taking care of a warranty issue on the spot. That's more than mere solicitation. And that's instant nexus. I had one come up the other day. It was a company that sells industrial cleaning products, like they might use over at Morel for sanitizing. If the salesman were just showing up, hey, these are my products, please try them out, please buy them, it wouldn't have been an issue. But then what this company did was there were issues with how well it worked. So the sales rep went to the facility and provided training on how to use it properly, how to make sure it's working, how you should be mixing it, more than mere solicitation. And that activity not only created nexus for sales tax, it created it for income tax as well, because he was providing more. Picture that Wild West guy opens a sample case and says, please buy whatever I've got, hands you the piece of paper and walks away. If it's anything more than that, you should probably talk to your tax people.
Dave, we have a few questions from online.
I'll try. What have we got?
Sorry, Dave, were you talking to me or the room?
What do we got for questions? Can you read them to me?
Yes, but I can barely hear you. Come closer to your laptop.
Can you read them to me?
Yes, we just went through some capital improvements in Sioux Falls. We incurred sales tax on both supplies and labor charged from each contractor. It does not appear that we are charged any excess tax. Are we responsible for this?
You might be. Send us an email. I'd like to see a couple of those invoices. See if I can figure out what the rest of the story is on that. But if you can send me a couple invoice copies, we'll see what's going on there.
Okay. If you hit the threshold for a state in 1 year, are you required to collect the tax in the next year?
Okay, question is, if I hit a threshold this year, am I required to keep filing? Yes. Crossing a threshold, getting nexus. Consider it like getting a tattoo. Once you've got it, you've got it. There's no givebacks.
Okay, we have two more. What if you cross the 100K threshold in November? Do all the sales occurred prior to November get passed on collecting sales tax?
Okay. The question there is, once I cross the threshold of 100 grand, do I start collecting tomorrow, or do I have to go back and collect for all the old news that got me up to the threshold? This is strictly a go forward deal. I haven't heard of anyone imposing it retroactive. So it's once you cross the line, then you need to begin collecting the tax. Does that help?
That's all I have on my end.
All right. Thanks, everybody.
Thanks, everybody. Have a good day.